In this example, we're going to be doing practice exercise 13-4A that can be found in your textbook on page 608. We are going to be doing the entries necessary to record a stock dividend. The problem tells us that Old Wine Corporation has 250,000 shares of $40 par common stock outstanding. On February 15th, the corporation has declared a 2% stock dividend to be issued on May 2nd to stockholders of record of March 27th. The market price of the stock was $52 per share on February 15th. In this example, we as the corporation are giving to our stockholders additional shares of stock as a dividend rather than cash. On February 15th, the date that we declare the dividend, it becomes legally binding to the company, so we have to record an entry. Stockholders that are on our record as of the end of the day on March 27th will benefit from the stock dividend, and we will send the stock certificates to the stockholders on May 2nd. When dealing with the stock dividend, the first thing that we need to do is determine how many additional shares of stock we are going to distribute as the dividend. And we do that by taking the shares that are outstanding and multiplying it by the stock dividend, which is given to us in a percentage. So in our example, they told us that we had 250,000 shares that were outstanding and that we were declaring a 2% stock dividend. That tells us that we are distributing an additional 5,000 shares of stock. On the declaration date, we need to do a journal entry because, again, it becomes legally binding to the company when we declare that dividend. We're going to debit stock dividends. This is an account that reduces retained earnings. Remember, retained earnings is an equity account, so it increases with a credit, and it is showing how much we've retained of our earnings in our business. We're now giving something back to our shareholders, so it's reducing retained earnings. Think of it as a sole proprietor when we did a statement of owner's equity. We put in the capital and we subtract away the drawing. We're doing the same thing here. We're taking away something from our retained earnings. And in total, we're going to take away the 5,000 shares and multiply it by how much the shares were selling for on the declaration date. And they told us that it was $52 per share. So again, the 5,000 shares that we're giving as a dividend multiplied by the $52 that each share is selling for at that time. We're doing that because that is what we as the company is sacrificing. Had we sold these 5,000 shares to new shareholders, we would have taken in $260,000. However, we are giving these free to our existing shareholders as a dividend. We're then going to create that liability of stock dividends distributable. That's going to be the 5,000 shares multiplied by the par value, because what we're going to distribute to these shareholders eventually is going to be common stock. And we know that our common stock cannot be credited for more than par value. And they tell us that they have a $40 par value. We take again the 5,000 shares that we're going to give and multiply it by par. Since our debits and credits don't equal, we know that we have to have another credit. And that credit is going to go to the paid in capital in excess of par on our common stock account for the difference between how much they could have sold for and the par value. That equals $60,000. Now, on March 27th, on our stockholder record date, there is no entry required. That is just telling us who will benefit from our stock dividend. On May 2nd, our issuance date, we need to eliminate our stock dividends distributable amount of $200,000, and we need to distribute our stock. Remember, this is a stock dividend, so we're not giving cash to our shareholders. We're giving them common stock in total of $200,000.